Ladies and gentlemen, on behalf of Captify Consulting Investor Relations team, I welcome you all to the Q3 and 9 months FY26 post-earnings conference call of Platinum Industries Limited. Today on the call from the management we have with us Mr. Krishna Rana, Chairman and Managing Director, and Mr. Ashok Bothra, Chief Financial Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, a reminder that this call is being recorded. I would now request the management to brief us about the business and performance highlights for the period ended December 2025, the growth perspective and vision for the coming years, post which we will open the floor for Q&A. Over to the management team.
Thank you so much, Vinay. Good afternoon, and thank you for joining us today for Platinum Industries Limited's post-earnings conference call for the third quarter and 9 months of fiscal year 2026. I am Krishna Dushyant Rana, Chairman and Managing Director, and I am joined by our Chief Financial Officer, Mr. Ashok Bothra, who will provide a detailed overview of our financial performance shortly. First, let me start by expressing my gratitude to our dedicated team, valued partners, and loyal shareholders for their continued support. At Platinum, we remain committed to our core mission of being a leader in manufacturing of PVC and CPVC stabilizers in India, delivering high-quality stabilizers, lubricants, and compounds that drive innovation in the construction, infrastructure, and manufacturing sectors. Turning to our performance, Q3 financial year 2026 reflects a resilience quarter amid a dynamic market environment. We achieved standalone revenue of 102.62 crores, marking a robust 31% year-over-year growth. This strong year-on-year expansion underscores the growing demand of our products, particularly in the PVC pipe and fitting segment, which benefits from India's ongoing infrastructure boom and urbanization trends. For the 9 months ended December 31st, 2025, our top line reached 302.38 crores, up 25% from the previous year, driven by strategic capacity expansions at our facilities and deeper penetration into key markets. Our focus on CPVC and sustainable low lead and calcium zinc, which are lead-free stabilizers, continues to position us as a preferred partner for environmentally conscious customers, aligning with global regulatory shifts towards greener materials. On consolidated basis, we achieve a revenue of 104.67 crore, marking a 12% year-over-year growth, and the 9 months ended December 31st, 2025, our top line reached 318.42 crore, up 7.7% from the previous year. Operationally, we made meaningful progress in optimizing our supply chain and R&D initiatives. We launched new hybrid formulations that enhance product performance while reducing environmental impact, and we expanded our export footprint, contributing to diversified revenue streams. Looking ahead, we are optimistic about growth in the coming years, with India's PVC consumption projected to grow at a CAGR of over 8% in the coming years. Fueled by the government initiatives like Housing for All and Smart City projects, we are well poised to capture this opportunity. We expect to accelerate our growth trajectory, targeting more than 40% revenue growth in financial year 2027 and a 35% CAGR from financial year 2026 to financial year 2029. This ambitious outlook is driven by a multi-pronged strategy, including the commissioning and ramp-up of our new facility in Egypt, which will unlock high-growth international markets and add cost-efficient capacity. Increase utilization and operational scaling at our new Palghar facility through capacity addition, automation, process optimizations, and efficiency improvements. Deeper market penetration in existing geographies via portfolio expansion and new products. And successful launch and scaling of innovative product lines to broaden our offerings and capture incremental demand. These initiatives combine new capacity, geographic diversification, enhanced utilization, and innovation to sustain high growth momentum while capitalizing on structural tailwinds in our core markets. We plan to invest further in these capacity augmentations and technology upgrades with our strong balance sheet featuring low leverage, providing the flexibility for both organic and inorganic growth. We value your trust and are committed to create long-term shareholder value through innovation, sustainability, and execution excellence. I will now hand over to our CFO, Mr. Ashok Bothra, for a deeper dive into the financials of Platinum Industries. Thank you. Thank you very much.
Thank you, sir. Good afternoon, everyone. It is a pleasure to discuss our financial result for the Q3 and 9 months of FY26 in more detail. Let me begin with key highlights for the quarter ended December 31st, 2025. On standalone basis, revenue came in at 102.62 crore, representing a 31% increase year-on-year basis from 78.47 crore in Q3 FY25, driven by higher volume of CPVC and improved product mix. On sequential basis, this reflects a 6% growth from 96.87 crore in Q2 FY26. Gross margins stood at approximately 31% against 32.6% due to higher proportion of CPVC sale, which has a lesser margin as compared to other products. EBITDA for the quarter was 16.25 crore with a margin of 15.8%. Profit before tax was 17.54 crores, up 15% YOY basis, while profit after tax reached 12.93 crores and 18% growth year-on-year basis and 6.5% sequential growth. On YOY basis, the main reason for higher PAT is increased sales volume, but partly offset by high COGS, depreciation, employee cost due to newly set up manufacturing facility at Palghar. EPS for the quarter was 2.35 rupee. For the 9-month period, revenue aggregated to 302.38 crore, a strong 25% YOY growth. EBITDA was 44.11 crore with a margin of 14.6%, and PAT stood at 37.58 crores. The moderation in PAT reflects the impact due to higher depreciation amid ongoing capacity expansion, lesser other income. Even revenue grew strongly. Other factor is like high COGS due to higher proportion of CPVC sale, which is high volume but less margin product. But this product has a high future potential. On balance sheet front, as of 31st December, we remain net debt-free company, underscoring our prudent financial management. We maintain a healthy cash position and liquidity for ongoing operation and future investment. Overall, our financials demonstrate resilience and a strong foundation for sustained growth. We continue to prioritize cost optimization, risk management, and shareholder returns. Thank you, everyone. I now open the floor for your questions and answers.
Thank you, sir. We'll now begin the question and answer session. All those who wish to ask a question, please use the option of raise hand. Alternatively, you can also post your question in the chat box. We'll wait for a moment till the question queue assembles. We'll take the first question from Mr. Bhargav Buddhadev. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a good set of numbers. Sir, my first question is that obviously now the PVC market seems to be turning in terms of prices going up. So is it fair to assume sort of some pre-buying on the back of that? Channel is again restocking. So is the volume growth likely to pick up on the back of increase in this PVC resin prices? Sir, you are on mute, sir.
Bhargavji, thank you for your question. If you understand the PVC scenario, let's consider 24, 25. 24, 25, the PVC consumption in India was somewhere around 43 lakh tons. From April, due to the prices that were continuously declining from April to December, in fact, when we were talking to Reliance also, there was a 10 to 12% degrowth in the PVC industry. But despite of the degrowth in PVC industry, the CPVC grew exponentially high. So what I feel is in the month of January, from mid-January, the prices have reversed back due to the 13% rebate policy in China that was taken back by the government, that has led to the prices going up, and the sentiments of the farmers and the retailers have grown better. So what I see is from January, the orders that we have definitely helped us to understand that there is the future, and the current run rate is growing for us. So the PVC consumption is going to grow from has grown from January this year.
Secondly, sir, if you can give us some update on the Palghar expansion. So I think the 12,000 ton CPVC plant is already operational. But what is the update on the remainder of the capacity expansion, and also an update on when do you expect the Egypt plant to start getting commissioned?
So the first phase, that was CPVC, we already started manufacturing in Palghar. So that is up and running. We are running at almost 60 to 65% as on today of that capacity of 12,000 tons. Regarding the calcium zinc, I think there was some problem with respect to the automation, which has been corrected this month. And probably from, I think, April, we should be having on a complete scale of production. So I think from April, we should be able to start the commercial production completely for calcium zinc and the lead-free lines.
And Egypt, sir, Egypt, when do we expect?
Egypt, we tend to complete the complete construction by end of May, and we will start the pre-commissioning by June. So mostly, I think by 1st of September, we should be able to start the commercial production if there are no problems. But we have told the exchange that December 2026 is the final outlook for the 100% plant running.
And lastly, sir, in your update, you mentioned about floating a new subsidiary for entering into pharma. So are you looking at making APIs or pharma intermediates or specialty chemicals which will go into pharma?
So basically, we have recently registered a company by the name of Rivadu Life Sciences Private Limited, and where Platinum is going to hold 70% and 30% is by one of the scientists who holds many patents in his name. Okay, so we are getting into different verticals of pharma with nutraceuticals, APIs, excipients, and different niche products. So not a common product, but this is something niche we are entering into. What we foresee is a good demand for the pharma products, and currently the process that we're going to follow is we're going to hire the production capacities of many pharma companies and sell it in the market, and then we will go into investing in capex post 2 or 3 years from today.
So are you confident of generating revenue in FY27 from this?
Yes, I can say so, but I cannot tell you the figures as of now. But yes, we are confident that 26-27 will be generating good revenue from the pharma business.
Because these will be all new customers for you, right? I mean,
yes, these will be our new customers. But since the product and the chemistry is not new for us, we are very confident that we'll be able to convert the customers into having a niche market for these products.
Great, sir. Thank you very much, and all the very best.
Thank you, Bhargav.
Thank you, Bhargav. We'll take the next question from Yash Jurani. Please go ahead.
Hello, am I audible?
Yes, Yash.
So, sir, I wanted to understand a few things, mainly regarding the value chain. So are the end users, say that the Platinum supplies to, being Astral, Prince Pipes, or Supreme, are they directly buying PVC compounds from their own tie-ups like Lubrizol or Gold Stab and cutting down on middlemen like Platinum, or like what is the scenario that is currently happening in the value chain? The last I heard was a company like Prince Pipes was in a long-term relationship with Lubrizol to get their own PVC and CPVC compounds.
So basically, Yash, Platinum is not acting as a middleman. Okay, number one, we are into hardcore manufacturing. The products that we offer to the let's consider there are two different products. One is PVC as a polymer, and one is CPVC as a polymer. Since you took the name of Prince Pipes was earlier using products of Lubrizol. So now they were buying complete compounds. Okay. If you must have analyzed in the past 1 or 2 years, India has come up with a huge capacity of manufacturing CPVC resin. Okay, and
Yes.
the customers wanted to move away from using a compound because in using a compound, companies pipe manufacturing, CPVC pipe manufacturing companies were basically what you can say a mediator or a mediator between Lubrizol, because Lubrizol gives material only when the customers are using their brand as FlowGuard. It's called a co-branding of their
Understood. Yeah.
they were always wanting to move away because the cost control was always in the hands of Lubrizol. They were not being able to control their formulation. What we did is we broke down and we entered into an additive sector, and we told customers who are manufacturing CPVC pipes, they will buy resin. So when you buy a compound from Lubrizol, 75% that compound is dependent on resin, and rest 25% is dependent on 20 to 25% is dependent on additives, different additives. Okay. And what we did is we told the customers that, we have developed an additive which will enhance your, the quality of your pipe, as well as it will give you an edge over controlling your 75 to 80% of the formulation. Means if they buy CPVC resin directly from the suppliers, they have the control of the resin prices. They have various resin manufacturers where they can buy resin from, right? So if someone is giving a product at 100, they can negotiate with somebody at 98 or 99 or XYZ price. So they have an edge to buy a resin directly. And they buy additives from us, and that is how they make a compound and extrude a pipe. So this is the area where we have entered and supplying additives and not the entire compound. Of course, we are also manufacturing
Understood.
compound for small customers where they require an entire compound and not just additives. But we are there with Supreme Industries. We are with Prince Pipe and Fittings.
Understood. So one more thing on the similar line, say one of the PPTs that was uploaded on the exchange in, I think around November 2024, had few of the management estimates of the revenues. And I think we are a year delayed in terms of the revenue that we were expecting in FY25. Like there was an estimate of around 450 crores. So how do we plan on getting that 40% CAGR that you just mentioned, say a few minutes back? Like what are the future plans that we say we jump from around, say we close this year at around 400 CR, and then next year we go to around 600, then 800. Like what are our plans? How are we looking forward to get those numbers?
So, if you understand our projections had that 450 crores will come from the India plant, and remaining 100 or 125 odd crores will come from Egypt plant. Unfortunately, the Egypt plant has been delayed by almost 9 to 12 months, and that is where our revenue has been shifted 1 year later. So that's the only gap.
Understood. Understood. I think that answers my questions. Thank you so much.
Thank you, Yash. We'll take the next question from Raj Shah. Please go ahead.
Hello, sir. During the IPO, I think the capacity utilization was around 40%, and currently you said it's 60%. So, what is the optimum capacity utilization achieved from our unit one?
Okay. Raj, we have a different product mix. Okay. Like, let's talk about stabilizers. Now, when we started in 2016, 2018, when we expanded our capacity, we have two forms. One is powder form and one is solid form. Solid is flakes form. When you make a product in a reactor, okay, it goes on a flaker and it converts into a solid form. And powder is just a blend, and you just pack it. In India, when we started the plant, we were not aware that whether the customers in India for the lead-free additives will be accepting the powder capacity, or they'll be accepting a flakes capacity. But we went with both the capacities so that the customer is having both the options in terms of having a better processability at their end. So when you talk about flakes, in unit 1, we were running at 95% of the capacity in flakes form. And the unit 2, the new unit we did, the 100%, almost 80% of the capacity that we expanded is in the solid form, that is in flakes form. So the powder capacity was utilized only 10%. Now today, what we've done is we've done some technology advancement, and we were being successful to launch a lead-free product. There is a pipe manufacturing. When the pipe manufacturer, they have a pipe manufacturing unit as well as a fittings. The fittings are where the pipes are joined with. So we were successful into converting the pipe manufacturers to fitting. Now our powder capacity is running at almost 20-30%, which is continuously increasing. So if you see the product mix, we will be able to answer you in terms of product mix that which product which is the highest sale is running on 90%, lowest sale is running on 10%.
Uh, to answer in a better way, so what is the revenue potential of our Indian factories? What is the revenue potential of our Indian factories?
Ashokji, would you like to answer this question?
So from new plant, we can generate a maximum sales revenue of say around 7 to 750 crores over a period of 3 to 4 years.
Okay. And from the unit
That
one,
is in PVC. That is in PVC. Only in PVC. In CPVC, it is somewhere around 600 crores.
so total 1400 crores, you are telling me.
Correct.
From unit one, from unit one?
From unit 1 and unit 2 both.
Okay, okay. So can you give me product-wise revenue bifurcation? Like how much revenue comes from which product?
So we will get back to you. You can connect with me offline. We will share with you.
Okay. And there's 40% FY27 projection and 35% CAGR is including pharma business or only PVC?
Sir, your voice is not audible.
Hello.
Raj, you are not audible.
Am I audible now?
Yes, please.
So my question is, this 40% FY27 growth and 35% CAGR for 3 years is including pharma business or it is only PVC?
This is other than pharma.
This is other than pharma.
Yeah.
Okay. And sir, recently we issued some shares of Platinum Oleochemicals to external shareholders. So what is the business of Platinum Oleochemicals and what is the reason for issuing shares to external shareholders?
So Platinum Oleochemicals, we are investing in oleochemicals derivatives. So we have recently been able. We are researching on these products. Like these are the products which are used for not PVC, not CPVC, but for the entire polyolefin sector. So whether it's HD, LLDP, PET, these oleo-based derivatives are used for all. So the companies which other companies are manufacturing these products? One is Fine Organics and one is Adani Wilmar. So since 2.5 years, since we have spent heavily on R&D and we were able to launch few products and sell it to the market, we have ventured into Platinum Oleochemicals and we are going with a higher capacity in future to manufacture these oleamide, uracamide, and different ester waxes for the entire polyolefins sector. So recently, Mr. Anand Pachigar, okay, who is also a family member, brother of my wife, and since I am the only person in the organization, I thought that I need some hands to handhold the other projects also. So that's how we have parted some 10% equity to Mr. Anand Pachigar and 0.5% equity to Mr. Anand Shankar, who was the ex Honeywell guy who's managing the entire technicality of this project. So Anand Shankar worked with Honeywell Additives for more than 12 years. He left and he joined Platinum as a business director, new product development and innovations. So he's the one who's setting up the oleo plant and the oleo plant for us.
Okay, so can I say there are total three businesses? One is PVC, which is established. But second is pharma, in which we are investing.
One is PVC. I'll tell you. I'll explain you in verticals. One is PVC. One is CPVC. One is oleo, and fourth is the new entrant is the pharma. Yes. So
Okay.
pharma, we are still identifying. Which way should we go, and how will we plan? So it's still under planning.
Okay. And sir, if I see, like our margins are continuously decreasing. Like in FY23, it was 23%. FY24 was 23%. FY25, 15%. And now is also 15%. So what is stable state margins?
So if you're asking a question that the margins are declining.
Yes, correct.
Okay. So CPVC basically has given a good revenue to us this year, and CPVC is absolutely a new product to the Indian market. So when you talk about new product into the market, we have not achieved the entire raw material cost in terms of, like, for example, in PVC, when we talk about lead free products, we are working on a contribution of say 30 to 35%. But in CPVC, we worked on a contribution of 7% last year. Then we increased the contribution to almost 12% in the first 2 quarters. In the third quarter, it came to almost 17%. So the new product has its own life cycle in terms of getting to its matured state, because the raw materials we are using from all renowned companies. So we need to find alternatives, and we were very successful in 2 quarters back to find the alternatives to make the formulation more effective in terms of having the same performance, but yet effective in terms of cost also. So that is what has led to the increase in little bit of margins for that.
Okay, so my last question is, yeah. So can I say that in Egypt business, the revenue potential is 600 crore, but with why we are targeting in 2 3 years we will reach 300 crores.
In Egypt,
Yeah, correct. In Egypt.
yes, I think you're right.
So why only within like 3 years is a good time. So only 50% utilization we are targeting in 3 years.
Ashokji, you have the Egypt numbers?
It is around around 250 to 300 crores over a period of 3 years, sir.
Yeah, correct. So what I'm saying is total revenue potential is around 600 crores. So 3 years is a pretty good time. So we are targeting only 50% utilization in 3 years.
I think Raj, you are not clearly audible.
Uh, well, I can chat. Well, I can chat.
Okay. We'll take the next question from Kruthat J. Please go ahead. Kruthat. So we'll move on to question from chat. It's from she's asking, can you elaborate your strategy and thought process to go to Egypt? How does it help us in terms of tapping markets, cost benefit analysis? Hello.
Yeah, I think they've not been able to hear that clearly, Mohsen.
Okay.
The question from Mrunal in chat is, can you elaborate your strategy and thought process to go to Egypt? How does it help us in terms of tapping markets, and what is the cost benefit analysis?
Correct. So thank you, Vinay. Like Egypt, basically Egypt holds around 20 FTA agreements, right? And if you talk about the strategic location, it's closer to the Western world. 20 FTA agreements means almost 130 countries can import from us duty free. So we have an access to 130 countries, whether it is South of America, whether it's America, KIZ industrial zones, Europe, Turkey, Middle East, the entire African market. We have a better edge into getting and penetrating to the markets faster. Talking about the kind of benefits that we have, just giving you a small example that which I always say, that why we went to Egypt was we wanted to cater to a customer in Uzbekistan from India. And we understood that for a 20 feet container, from India to Uzbekistan was somewhere around $5,500 to $6,000 for a 20 feet container. And that's when we realized that where are they buying from? So they were buying from one of our competitors in Turkey, that is Ekdeniz Kimya, and Ekdeniz Kimya holds a very strong market share in the Middle East side. That's what this is the same thought that led us to think that we should have a plant which is close to the Western world, and that's where we realize that India and Egypt, they hold a bilateral agreement, and the benefit is that if we wanted to supply to an Uzbekistan customer from Egypt, it was somewhere around only $450 to $500. So the gap was really big that time, and that's where we decided and to put a plant over there. The benefits of putting a plant over there is like, let's the electricity cost, which is the biggest benefit. We have a plant in Maharashtra where the per unit cost of electricity is somewhere around 14 and a half to 15 rupees per unit. But if you go to Egypt, it's 2.93 rupees, 3 rupees per unit. So that's a huge benefit in having a operational efficiency in terms of manufacturing these products. We have set up a plant for lead-based commodity. So let's understand, if we are manufacturing a lead-based product, we are fetching a contribution margin of 18%. But if in Egypt we are manufacturing, we are fetching a contribution margin of almost 22 to 23%. I think this difference itself will make you understand that the operational benefit is much higher as compared to India.
The second part of a question is, what are going to be your focus products from Egypt?
Lead, as I mentioned, that our major capacity is lead and stearates, that are metallic stearates, which are used for the petrochemical industries. We are also setting up a plant for CPVC, but we are still identifying that how easy for us is to supply from India to the South American and the North American markets. So we are also setting up a plant for CPVC compounds over there.
The third question is, you have put out an announcement regarding setting up of a new subsidiary where you plan to take at least 70% equity stake. Can you throw some more light on that?
That
And
is the
who will have the
pharmaceutical which we
remaining
already
30%?
Yeah, that is the pharmaceutical which we already spoke on. I think Mr. Bhargav's question was the same in the start, that we registered a company called Rivadu Life Sciences Private Limited, where 70% is Platinum Industries and 30% is a very renowned scientist who holds many patents in his name. So as we are getting into pharma sector.
Sure. Raj had a problem in the line, so he sent his message on the chat. The Egypt business, am I right in saying that revenue potential is 600 crores? If yes, then why in 3 years we are targeting only 300 crores? That is 50% utilization.
Yeah, because it's a new plant, it's a new geographical location for us. Initially it takes time to build up the capacities and build up the sales also. So I think every company or manufacturing company has its own cycle. Like in India, when we started, we had it took us almost 4.5 years to reach even cross even 40%, 50% capacity what we had installed. So I think the company has its own life cycle.
We'll take the next question from Yash Jurani. Yash, you can go ahead, please.
Hi, sir. I just wanted to confirm few things again. You just said that in the Egypt plant, you are focusing on a lead-based capacity majorly for the petrochem sector. Can you
Not
describe
for
a few
petrochem, there are
products?
many products, lead stabilizers. Then there are products which we are going to manufacture for the petrochemical companies, which are stearates, metallic stearates.
So when we say look at the overall industry, like companies are more focused on moving away from lead-based or lead products. And we are trying to set up a factory where our majorly products will be on the lead-based side. So how does that add up? Like, I want to understand what your thoughts are on that.
So the market area from Egypt that we are going to cater to is Africa, Middle East, Turkey, Russia, America. Of course, for American markets, we are mainly focusing on CPVC, and we will be having a very small little capacity for calcium zinc for the transplant application for the American markets. So why lead more is because the demand and the notifications have not come globally for in countries in African region, that they have to stop the usage of lead. In Russia, it is not there. In Saudi Arabia and Middle East, it's not there. So say tomorrow, say in 24 hours or in 36 hours, everybody says that, tomorrow we'll stop lead. Our machines are going to be the same. We just have to have a cleaning of the machine, make it more potent, and then start manufacturing calcium zinc on that.
Understood. Yeah. Thank you.
Thank you. There's again a question in chat from Krutarth. Hello, sir. Congratulations on great set of number. Two questions. First, any scope of margin expansion after commencement of operations in Egypt? And the second question is, any future plans on inorganic growth through acquisitions?
Regarding first question, the margin expansion, yes, we are expecting a margin expansion in Egypt with the lead products. As I explained you earlier, that in India, due to the operational efficiency over there, we see that the margin expansion is quite visible for us. Secondly, the second question was with respect to Vinay.
Just a second. With
Yeah,
respect
no.
to any future plans on inorganic growth through acquisitions?
Yes, we might eye acquisitions as and when we want to grow. So probably our major focus is mainly on the current capacity to be filled in, and of course, acquisition is a way to grow the company. Also, in future, we definitely have it in mind.
Okay. Anybody else who wishes to ask a question, please use the option of raise hand. There is a question in chat from Ashish Barod. Any specific reason for the name of the new subsidiary as Rivadu?
Sorry,
Any specific name for the name of the new subsidiary as Rivadu?
the question is why Rivadu? What is the
Yeah.
meaning of Rivadu? Is
Yeah.
this? So Rivadu is like Rivan is R.I. My son, my elder son's name is Rivan. So R.I.V. is Veer, my younger one V, and A is Abhigyan, who's with us, and D.U. is Dushyant, my father's name. That's how we arrived at Rivadu.
Okay. We'll take the next question from Dhiral Shah. Dhiral, you can go ahead, please.
Yes, sir. Sir, last 2 years, sir, we have seen a very good increase in the overall gross block of the company. So, can you explain in detail, Kevin, where we have expanded our capacity?
Sure, Ashokji, would you like to answer this, please?
Would you please repeat your question, sir?
Sir, in last 2 to 3 years, we have seen a very good, capex, and that is why our gross block have also expanded in last 2 3 years. So, if you can explain, where we have expanded our capacity, in which product categories?
So our main products are PVC stabilizer and CPVC stabilizer. Okay. So we earlier our capacity was around 30,000 metric ton. Now it is 60,000. So capacity wise we almost doubled. And in Egypt also we are setting up plant for manufacturing products, similar products with a capacity of around 60,000. So capacity wise it is around more than it will be around 2 to 2.5 times. So as of now, we are not able to utilize fully. So by March or April, we will be fully utilize this Palghar facility. So there will be growth in the volume as well as in revenue. And from Egypt plant, say we will be able to, the plant will be available to us for a period of say 6 months in this year, FY27. So over a period of 3 to 4 years, we are expecting a growth of around say with a CAGR of around 40% minimum, and with commensurate margins.
Okay, and sir, if you can bifurcate how much of the percentage of revenue coming from PVC stabilizer and how much is from CPVC stabilizer, and in Egypt where we have increasing our capacity or putting up a 60,000 ton capacity, is it purely a PVC capacity over there?
So roughly, if you ask me, say if you break down say sale of around say 1,500 odd crores, so around 200 odd crore will be coming from lead stabilizer from India, 250 from lead, around 400 will be lead free. Then again, lubricants around 100 crores. And CPVC will be around 260 crores. And from Egypt, it will be mainly lead based stabilizer. It will be around 250 odd crores. Then other oleo and other products are there. So they will contribute around 250 crores. So these are the basic breakdown of the top line over a period of say 4 years?
So for Oleo, sir, how much of the capacity or what is the capex that we have done for this particular segment?
So we
This
have
will be
we have not done any capex for the Oleo. We have just invested heavily in the R&D in terms of research and development in past 2 years. Today, what we are doing is we are for the Oleo business, we are going through a CDMO process, and we are getting it made from different companies based on our research and development. The quality of our product depends on us, and we're going to do a seed marketing for at least 1 year. And basis on that, I think by next year we plan to invest in a 40,000 tons of capacity for the oleamides itself and the derivatives.
And what will be the capex requirement for the same, sir?
So the capex for the oleochemicals would be somewhere around 150 to 200 crores.
And how we are looking to fund this capex?
So through a debt route, or it depends at that time. What is the situation? Maybe we do it with an internal accrual or through a debt route, or maybe raise some equity.
Okay, and sir, when you are going to start your Egypt capacity, let's say from maybe September or maybe Q3 onwards, what kind of
Yes.
margins we are expecting in this segment? As you mentioned, that there is a high amount of operational efficiency because of the lower power cost and maybe lower freight cost. But what will be the overall margins that we are looking to generate in this region?
So at a optimum, at an optimized level, I feel that somewhere in lead, if as I explained earlier, that in India we are somewhere in 18 to 19% of contribution margins in lead. It's a highly commodity product, but in Egypt we should be it should be somewhere around 23 to 24% of contribution margins.
So this will be EBITDA margins, sir, 23 to 24%.
These are contribution gross margins.
But on the EBITDA side, how much it would be generating, sir?
On EBITDA, I think on EBITDA it would be generating somewhere around, because this will be we are starting only lead, so it's a total 60,000 tons of capacity. Lead is around 30,000 tons. Lubricants is somewhere around 5,000 tons, 15,000 tons, 12,000 tons is around stearates, and around 20,000 tons is CPVC. So when you talk about only lead, I think I don't think I'll be able to justify this, but it would be somewhere around 12 to 13%.
So I'm asking on the overall basis, sir. Once this maybe 60,000 ton capacity
Ashokji,
optimized.
you have the futuristic projections. If you can just guide them the 3-year scenario from today.
So
If I can say.
we'll avoid giving any specific
Okay.
annual numbers. We'll give a broad guidance.
Okay.
So broad guidance is 12 to 13% EBITDA margin from the Egypt segment.
Correct. Initially, but I feel that it will go up to 15-16%. So initially, for first few years, it will be first 2 or 3 years, it will be around 12 to 13% on lead products.
So now when the PVC prices have started moving up, so do you feel that maybe going ahead, let's say in FY27, India PVC business will give us the good margins? Because if I look at your 24, 23 numbers where margins were about 20%, and now it has came down to 15%. So do you feel that kind of margins are achievable once again?
So, the margins are, I think the projections that we have shown also, it is somewhere, for the entire portfolio, we have shown that, 11 to 12% is going to be our PAT margins, right? So somewhere, I think 15, 16, 17% is what we'll be able to, maintain it with the product mix.
Okay, and sir, just last one question, sir. If I ask, in the December quarter, we have seen a 1% reduction in the promoter stake. So, any particular reason for that?
We had sold somewhere around 430,000 shares, in the market, because there were some personal loans which I had to get rid of. So this is what led. I had just sold around 4 lakh, 0.87%.
So, any future, stake sale kind of a thing, or maybe this is what we have,
Not
able
planned
to.
anything in the short run at all. Nothing planned.
Okay, so no further stake sale or maybe no selling of shares. Okay, okay. Thank you so much, sir. That's it from my side.
Thank you, Dhiral. Since we have a hard stop, we would like to request the management to give in their closing comments. Would you like to give in your closing comments, Krishna?
No, thank you. Thank you so much. It was really pleasure meeting all of you. And we just wish for all of your prayers for Platinum Industries.
Thank you.
Thank
Thank you to all the participants for joining on the call, and thank you to the management team. This brings us to the end of today's conference call. Thank you.